Welcome back to the show, folks. It's your favorite money man, Vivvec, here to talk about something that gets my blood pumping: swing trading. Now for you newcomers, swing trading isn't about buy and hold forever. No. This is about capturing the meat of the move, the sweet spot of a trend over a few days or weeks. It's a game of timing, a game of nerve, and most importantly, a game of volatility. You can't make money on a stock that just sits there like a lump of coal. You need action, you need movement, you need stocks that dance, that jiggle, that give you a chance to get in and get out with a profit. That's where the magic happens, people. Volatility is not the enemy, it's the opportunity. It's the engine that powers the swing trading machine. Think of it like a roller coaster. A flat ride is boring, right? You want the dips, the climbs, the twists, and the turns. That's what makes it exciting, and that's what can make you rich. We're diving deep into the world of exchange-traded funds, or ETFs, that are famous for their wild rides. These aren't for the faint of heart, mind you. These are the instruments that the pros, the active traders, the people who live and breathe the market, use to make their moves. So grab your notebooks, get ready to take some notes, because I'm about to give you the inside scoop on 5 ETFs that could be your ticket to swing trading glory in 2025. These are the big boys, the movers and shakers that can hand you tremendous gains if you play your cards right. But remember, with great volatility comes great responsibility. Are you ready? Let's get into it. Booyah! First up, let's talk about the granddaddy of volatility itself, the ProShares Ultra VIX Short-Term Futures ETF, ticker UVXY. Now listen up, because this one's a different kind of animal. It doesn't track a company, it doesn't track a commodity, it tracks fear. That's right, UVXY is designed to deliver leveraged results corresponding to the S&P 500 VIX Short-Term Futures Index. In plain English, when the market gets scared, when chaos reigns and investors are running for the hills, this baby is designed to go up. It's a direct bet on market turbulence. This is why the short-term traders, the day traders, the swing traders, they flock to UVXY. They know that a sudden news event, a bad economic report, or just a wave of panic can send this ETF soaring in a matter of hours or days. You're not buying a piece of a business here, you're buying a piece of the market's anxiety. It's a powerful tool. But let me be clear. This is not a long-term investment. This thing has a nasty habit of decaying over time, a phenomenon called contango. You don't marry UVXY, you take it for a wild, profitable dance and you get out before the music stops. Think about it. You see the storm clouds gathering on the horizon of the S&P 500. You see the talking heads on TV getting nervous. That's your signal. You jump into UVXY, you ride that wave of fear, and when the calm returns, you take your profits off the table. Ski douche, it's a classic contrarian play. It's for the trader who can keep a cool head when everyone else is losing theirs. It's a pure, unadulterated volatility play, and that's why it's number 1 on my list for the boldest of traders. Alright, let's flip the script. What if you're not a bear? What if you're a charging bull? What if you believe the S&P 500 is about to rip higher? Then you need some horsepower, some leverage, some serious oomph. And that, my friends, brings us to the Direxion Daily S&P 500 Bull 3X shares, ticker SPXL. The name says it all. This ETF seeks to deliver 3 times the daily performance of the S&P 500. 3 times. You hear me? If the S&P goes up 1%, SPXL is designed to go up 3%. Catching. Now this is where swing traders' eyes light up. Why settle for a modest gain when you can amplify it? If you've done your homework, if you've analyzed the charts and you're confident the market is poised for a multi-day rally, SPXL is your weapon of choice. It allows you to make a powerful, concentrated bet on the direction of the broad market. You get more bang for your buck, turning a decent market move into a spectacular personal gain. This is how you can potentially turn a small account into a big one. But you have to be right. But let me pound the table on this. Leverage is a double-edged sword. It's a roaring lion that can either carry you to victory or eat you for lunch. If the S&P 500 drops 1%, this ETF is designed to drop 3%. The same power that magnifies your gains will magnify your losses. This is not a set-it-and-forget-it ETF. Because of the daily rebalancing, its long-term path can get weird, a phenomenon known as volatility decay. You use SPXL for a specific mission, to capture a short-term, high-conviction move to the upside. Get in, hit your target, and get out. Don't get greedy. Let's move from the broad market to the cutting edge, the bleeding edge of innovation. I'm talking about the ARK Innovation ETF, ticker ARKK. This isn't your grandfather's index fund. Oh no, this is a portfolio of pure, unadulterated disruption. Kathy Wood and her team at ARK are looking for the companies that are changing the world. DNA sequencing, robotics, artificial intelligence, energy storage, blockchain technology. These are the industries of tomorrow, and their stocks can move like lightning today. This focus on high-growth, often not yet profitable tech companies, is exactly what creates the volatility that swing traders crave. One day, a company in the portfolio might announce a breakthrough, sending the ETF soaring. The next, a competitor might emerge or a clinical trial might disappoint, causing a sharp drop. The price action on RKK is not a gentle slope. It's a mountain range with towering peaks and deep valleys. This constant ebb and flow, driven by news, sentiment, and big-picture thematic bets, provides a steady stream of trading opportunities. For a swing trader, ARK is a goldmine of setups. You can trade the breakouts when it pushes past resistance, you can buy the dips when it pulls back to key support levels, and you can play the reactions to major tech news. It's a proxy for the entire speculative growth sector. When investor appetite for risk is high, RKK flies. When fear takes over, it gets hit hard. Understanding that risk-on/risk-off dynamic is the key to trading this ETF successfully. It's a bet on the future, but you're trading it in the here and now. If you think tech is volatile, hold on to your hats because we're heading into the biotech sector. I'm talking about the Spider S&P Biotech ETF, ticker XBI. This sector is the definition of a high-stakes game. The companies in this ETF are working on the next miracle drug, the next revolutionary medical device. They are literally trying to cure diseases and extend human life. The potential payoff is enormous, but the risks are just as massive. This creates a perfect storm of volatility that is music to a swing trader's ears. Think about the catalysts in this space. A single company in the XBI can have its fate decided overnight by an FDA decision. A pass can send the stock up 100%, 200% or more in a single day, lifting the entire ETF with it. A fail can wipe out 80% of its value, dragging the ETF down. It's a constant cycle of clinical trial data, regulatory approvals, and M&A rumors. This isn't about earnings reports every quarter. This is about binary events that can create explosive, unpredictable moves. That's the playground for a swing trader. What makes XBI particularly interesting is that it's an equal-weighted ETF. This means that the smaller, more speculative biotech companies have just as much influence on the price as the larger, more established ones. This prevents a few big names from dominating the fund and ensures you get the full, unadulterated volatility of the entire sector. You're not just betting on one company's drug trial, you're getting exposure to the entire high-risk, high-reward biotech ecosystem. It's a wild ride, but for those who can stomach the risk, the potential rewards are off the charts. Last but certainly not least, we have an old favorite, a true heavyweight champion of the trading world, the Invesco QQQ Trust, ticker QQQ. This ETF tracks the NASDAQ 100 index, which means you're trading the 100 largest non-financial companies on the NASDAQ. I'm talking about the titans of tech: Apple, Microsoft, Amazon, Nvidia, Google. These are the companies that dominate our daily lives and the stock market. You might think these big established companies would be boring, but you'd be dead wrong. The QQQ is a hotbed of activity. Because it's packed with the most popular, most followed, and most debated stocks in the world, it has incredible liquidity and massive trading volume. This means you can get in and out of large positions with ease, which is critical for active traders. The tech sector is inherently more volatile than the broader market, driven by innovation cycles, fierce competition, and high expectations. When tech is in favor, the Qs fly. When sentiment turns, they can fall hard and fast, creating fantastic opportunities on both the long and short side. What I love about the Qs for swing trading is the clarity. The chart is clean. The support and resistance levels are well defined and respected by millions of traders around the world. You're not dealing with some obscure, illiquid stock, you're trading the consensus view on the most important sector in the global economy. It's a purer play on tech momentum than almost anything else out there. Whether you're a beginner or a seasoned pro, the QQQ should be a core instrument in your swing trading toolkit. It's reliable, it's liquid, and it always brings the action. There you have it. 5 powerful ETFs that are practically built for swing trading. From the fear-fueled sprints of UVXY to the triple-leveraged power of SPXL, the disruptive innovation of AirKK, the biotech gambles in XBI, and the tech titan battleground of QQQ. Each one offers a unique way to play volatility and capture those market swings. But I need you to listen to me, and listen closely. This is not a game for amateurs who haven't done their homework. This isn't a get-rich-quick scheme, this is a business, and you need to treat it like one. Before you even think about putting $1 single into any of these, you must, I repeat, you must do your own research. Understand the mechanics of each ETF, especially the leveraged and inverse ones. Understand the risks of volatility decay. Look at the charts, identify your entry and exit points, and most importantly, have a plan. And part of that plan is risk management. Know how much you're willing to lose before you even enter a trade. Use stop losses. Don't bet the farm on one idea. The goal is to stay in the game long enough to let your winners run. Trading these instruments can be incredibly rewarding. It can be your path to financial freedom, but it demands respect. Respect the market, respect the volatility, and respect your own capital. Educate yourself, stay disciplined, and never stop learning. That's the real secret to winning. Now go out there, do the work, and make some money. Booyah!